Well, let's have a look at the markets picture. Shares in Chinese tech firms mostly rose in mixed Asian trading, with oil prices falling more than 3%. The Hang Seng Tech Index rising 2.6%. In Japan, the Nikkei slipping 0.7% in its afternoon close. In the U.S., stock futures were mixed as the week is filled with key economic reports, and that has kicked off with investors continuing to watch the Federal Reserve's planned interest rate hikes. Investors are looking forward to the job openings and labor turnover survey, also known as the JOLTS, that comes out this week. This is the report that has one set of employment data that the Federal Reserve is watching closely as it tightens monetary policy. To talk to us about the latest market dynamics, we are joined by Gary Booysen from Rand Swiss. Gary, thank you so much for your time. How is our JSE and the Rand, of course, performing, given what we are seeing global markets, and also with the fact that we've got China locking down Shanghai?
So there's a lot of movement in the underlying market, but the local currency certainly is ignoring it. So we are hovering at those very, very strong levels that we saw from the close on Friday, sitting at about 14.54 to the dollar currently. We're seeing, against the pound also just above that 19 rand to the pound level. So the currency is pretty firm, even though we are seeing commodity counters on the back foot. So we've got the resource index down almost 1.5%, largely being driven by a fall in platinum prices. You've got platinum down, almost 2%, down about 1.7% currently. And as you say, China locking down that market, or at least it looks like it's going to lock down Shanghai in two separate moves. And that putting the Chinese markets under a little bit of pressure. The Chinese tech sector, however, did manage to rise 2.5%. And I think that's helped to lift our industrial sector. It is flat at the moment, but not taking the kind of pain that we're seeing in the financials, which are down almost, at least just over 1%, and of course that resource index. Iron ore futures do seem to be rising. So in Australia, we did see some of the iron ore miners on the front foot, but the big losers today are going to be the platinum miners. You've got the likes of Sibanye, Stillwater, Implats, Northam, all down, significantly in today's trade.
Right. So let's talk a little bit more about, I suppose, when it comes to Chinese markets and how you're viewing them, at least when we look at the biggest risk factors, because you've got analysts that are kind of having a bit of doubts when it comes to China's ability to lock down cities to maintain that COVID zero policy. I mean, what do you think will be the biggest risk to the Chinese markets? Is it the tech side or economic growth? How are you seeing things?
So if you look at the zero COVID strategy that China's been pursuing at the moment, I think you had to assume that at some point you were going to see, a more prevalent, more virulent flare-up of the virus. And this does look like an Omicron variant, which does seem to be a lot milder. And there's a lot of call inside China to allow it to progress and to almost relax that zero COVID strategy, because just the cost of testing in China is actually fairly exorbitant. With the lockdown of Shanghai, it does look like production is going to be halted for the period, and that's obviously going to have an impact on Chinese Chinese production, but Chinese manufacturing, the Chinese financial firms as well. That said, there's been a big shift in the rhetoric from the Chinese authorities around their tech sector specifically, and the idea that they are going to work with the US government to try and maintain some of those ADRs, the American depository receipts, on companies like Tencent and Alibaba, and that's just to help boost sentiment around the tech sector, which has really been falling, not because of COVID-related matters, but because of the stringent regulations that the Chinese government has put in place there. So I think you're seeing a little bit of optimism in tech, and the market has been punished over the last year and a half. So that's, I think, why you're seeing the HS Tech Index up over 2% today, even in spite of the lockdowns in China, which will probably hit more the manufacturing sector. That said, if we do see a relaxation of that zero COVID policy, I think you could potentially see it in Chinese markets once the virus has kind of burnt its way out, if you want to put it that way.
So the one thing I wanted to mention is that there's this very interesting narrative that I've been following over the past couple of weeks, and the narrative goes that one shouldn't be buying bonds right now because they're going to be hardest hit. One should actually be investing in equities, because the idea is that, well, stocks will be your inflation hedge. And I'm wondering, what do you make of that particular narrative? Do you subscribe to that right now?
Well, I suppose it all depends on pricing, doesn't it? And it all depends on where you're finding value. So, when you're in a high inflation environment, yes, stocks do offer a fantastic inflation hedge, but again, it depends on the type of stock that you're looking at. So generally, in a high inflation environment, if you've got a company that holds physical assets that are going to become more valuable, if they sell products that are going to be able to increase in prices along with inflation, you generally are holding a pretty good inflation hedge. If you're looking at a long-term bond where you essentially locking in for 10 years at a fixed interest rate, in a high inflation environment, you tend to get interest rates increasing. And as investors should know, when bond yields increase, the actual capital of a bond price falls. It almost works in the inverse way, and rising interest rates are not good for bond markets. But it really depends, as I said, on the pricing. So at the moment, we are seeing a big sell-off in the bond market, which is forcing bond yields a lot higher. And if you're looking at a 2 or 5 year bond where you can get a significant yield over the period, and you believe that it may be the inflation, there's too much in the way of inflation expectations baked into the product, it could be a very, very good investment. So it depends on the price. And the bond market is fairly diverse. You could look at corporate bonds, government bonds. There's all different geographies. There's a lot that goes into it. And I think if you're looking at South African bonds specifically, I think we are actually fairly attractive compared to some of our emerging market peers. Looking at the yields that you can generate currently, but yes, if you're looking purely at inflation, I'd probably say stocks are a bit, with a very qualified answer, but I'd probably say stocks are the better place to be.
We've got less than a minute left. Just quickly, how cautious are you right now in this environment?
I think you've got to be fairly cautious. If you look at what it looks like an inversion in the bond yields, and if you look at what's happening in the Ukraine and Russia, I think there's a very good chance that we're going to see the world going into recession. Now, the question I think investors have to be asking is which sectors have been punished hard enough, which stocks are down heavy enough that they're now presenting real value, and then that's probably the place that you should be accumulating. So. For me, I think you do have to take a more cautious turn. We're looking at more defensive stocks. We're looking at stocks that have fairly low gearing because we expect interest rates to increase, and we want companies that have fairly solid balance sheets.
Yeah.
At the same time, you've got to look at companies that are able to increase their margin. But I think again, you look at the JSE. We've got commodities do fairly well in high inflation environments. We're stocked full of commodity type stocks, and our small and mid cap sector are trading on incredibly attractive multiples. And I think those businesses, having gone through COVID and proven that they're robust enough to stay afloat, might not be a bad place to be looking to deploy some money.
All right, Gary, let's leave it there. Thank you so much for your time. That is Gary Booysen from Rand Swiss. And of course, just what we are looking out for Wednesday, we've got US fourth quarter GDP numbers, as well as the OPEC meeting on Thursday. And of course, we'll keep you updated on all of that.